Welcome. Today's Thursday, December 15th. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and founder of Alpha Insights. And this is your Daily 5. We're going to get right into it today with chart number 1. We've noticed a lot of divergences, and the question we're asking is, while divergences abound, will the S&P go down? Let's take a look here at what we're observing in this chart is the Dow Jones on a daily closing basis versus the NYSE cumulative advanced decline line in the lower frame. Now, as all will know, the Dow has rallied over 20% off the October lows before topping on a closing basis on December 1st. Now, the Dow's outperformed all of the other major U.S. Stock market indexes, and probably most notably, this very narrow group of highly liquid, high quality, dividend paying large cap issues also holds the single distinction of being the only index so far to exceed its August high. So meanwhile, we look at the NYSE cumulative advanced decline line. It posted a significantly lower high versus the August peak, leaving what is known in the trade as a bearish negative divergence between the two series. Now, probably the most interesting thing about this is this exact same condition preceded the decline off the January top. And in fact, the current divergence is much deeper and broader. And so the significance of this divergence appears to be greater than it did at the top. And so as a result, we would expect the reversal to be of a greater magnitude. So we are on alert for a reversal of trend here in the Dow and the broad market as well. Let's take a look at chart number 2. Chart number 2, we've entitled Momentum Divergence. Now here we're looking at a chart of the S&P 500 on a daily basis, daily range chart. And in the lower frame of this, we're looking at the 10-day momentum study of the same. So a negative divergence is also now evident in the momentum study of the S&P 500. And typically when the price of a security or an index posts a higher high that is unaccompanied or unconfirmed by a like new high in the momentum study, it's known as a divergence, and it typically indicates trend exhaustion. So, looking back over the past year for the S&P 500, we can see that it has posted a similar negative divergence at virtually every prior tradable peak. Now, in our view, the current setup is now even more extreme than it has been at any previous point this year, because there appears now to be a triple negative divergence in place. That's two negative divergences, basically. And as a result, we are on very high alert for a significant trend reversal to the downside in the price action of the S&P 500. We're starting to see some of it today, following this week's fireworks between the CPI data print and the Fed's decision to raise interest rates 50 bips yesterday. But more importantly, their hawkish tone coming out of the meeting. Let's move to chart number 3. Chart number 3 highlights a volatility divergence. In the upper frame, again, we're looking at the S&P 500 daily range chart. In the lower frame, we're looking at the VIX on a daily range basis. And, there has been a relatively stable relationship between both the S&P 500 and the VIX this year. And at each point, the VIX has reached a level that it's exceeded 34%. It has very nearly marked each tradable low for the S&P 500. Conversely, when the VIX has reached a level below 20%, and then reverses above its descending trend line, as it has in each of the prior cases this year, it has coincided very closely to each of the 4 major highs in the market. And right now we're looking at a VIX that is rallying off of a recent low achieved on December 2nd. That low is 18.95%, and it has since reversed above its descending trend line. Interestingly, on December 13th, the VIX made a higher low just as the S&P made its recovery high, which was just less than a half a point actually above the December 1st high on an intraday basis. But nevertheless, it was a new high, and that constitutes a positive divergence on the volatility index, which is akin to a negative divergence in momentum. In other words, we want to think about volatility going higher as a result of the positive divergence, and that would be suggestive of equities rolling over. We expect the VIX to spike substantially higher, and I would not at all be surprised if the VIX didn't at least challenge the 40% mark, which it hasn't printed in over 2 years. In fact, we do have some view that we could actually exceed 40% this time around. We'll see. Continue to watch it, and we'll keep you informed in these videos when we do see this. Let's move to chart number 4. Chart number 4 takes a little bit of a different tact here. We've noticed a short interest divergence. Now, everybody knows investor sentiment survey data remains very, very bearish. In fact, the whole contrarian bullish buy signal, that's generated by bearish investor sentiment data, is very popular. It has a so-so track record of calling tradable market lows. It works best when we're reaching, extremes. And in some respects, we have reached an extreme, but not necessarily the extreme. The bulls, however, have been leaning very heavily on the bearish survey data as the reason to be long stocks in 2023. But if we look at the short interest in the SPY, it is now the lowest since January of 2022 when the market topped. Now, this has been a major source of buying power, but we think this is all but dried up at this point and is no longer a tailwind for the bulls. Keep in mind that when short interest is high and the market begins to rally, the shorts cover, and they are natural buyers, right? And those natural buyers fuel the rally. When short interest is as low as it is right now, there is a much lower base of natural buyers out there. And so when the market starts to go down like we're seeing today, there really isn't a pool of natural buyers to build up support there. So this opposite condition has also existed at the February, June, and October lows. And so we think that this is pretty indicative of the fact that the market just has a lot of wood to chop on the way down from here. Let's take a look at slide number 5. We've divided this into an A and B slide, and the first is kind of a short-term view of the market. This is an S&P 500 4-hour intraday range chart that dates back about 4 months to the August 16th high, to be exact. We're calling this our short-term Elliott wave model, and just given the impulsive 5-wave decline that we've countered into the October 13th low and the choppy overlapping advance that has followed, we must conclude that this rally is of the counter trend variety. And the reason for that is if we take a look at the decline off the August high into the October low, it's a clear impulse wave. We can count 5 waves down at minor degree and ultimately at intermediate degree of trend. The reaction off of the October 13th low is very overlapping, very choppy, and it's actually taken longer. The decline lasted only 58 days from August 16th to October 13th. The rally thus far has been 61 days through today, and in fact, it has not recovered above its minor wave 2 decline. And so, we think at this point we can conclude with high confidence that this is a corrective wave, a counter trend rally. And in our view, this counter trend advance in the S&P, had the potential to reach the 4118 level. That's where the Y wave of this final leg up would be equal to the initial wave up, wave W. And so that's kind of a common relationship in Elliott wave parlance. And so that would have occurred at about 4118. We got to 4101, so just 17 points shy of that. Close enough for government work, right? There was the potential that we could possibly see the market push up to the Fibonacci 786 retracement. That would have come in at 41.47. That was our stretch target for this, corrective rally. We don't think that's likely to occur at this point. In fact, if we take out the shelf of support that kind of marks that B wave of the wave Y up, we can see that that would clearly represent a breach of 3,900, and that level to us would be consistent with the next move down. So in either case, we expect this rally to fail. We expect the bear market to resume its decline to new lows. So how low can it go? Let's take a look at chart 5B. This is a series of charts that we've been presenting for some time now. This is our long-term Elliott wave model. Our preferred count assumes that the January high marked the end of cycle wave 5 of super cycle wave 3. We illustrate that in the cycle wave chart on the left side of the screen. And what we've seen under this rubric is a decline into the June low, which counts best as primary wave 1 down of cycle wave A. The rally into the August highs thus counts as primary wave 2 up of cycle wave A down. And as such, the initial subdivisions of primary wave 3 of cycle wave A down have been underway since. Now, we've counted the October low as intermediate wave 1, as we illustrate in the primary degree chart on the right-hand side of the chart of the screen. And that intermediate wave 1 down was followed by a counter trend advance that ended on December 13th, apparently. And that appears to have topped right at the 50-week simple moving average, also right in line with the trend line off of the prior highs. And it appears to have terminated intermediate wave 2 of primary wave 3 down. As a result, that puts us at now the precipice of a third wave decline at both intermediate and primary degree. Our initial downside target suggests that the S&P can reach the 2750 to 2400 range before primary wave 3 terminates. Primary wave 3 will be followed by primary wave 4, which will be a counter trend advance, most likely a lateral consolidation, and then a final plunge in primary wave 5 down to complete and terminate cycle wave A, which should end at or about the 61.8% retracement of the advance off the March 2009 low into the January 2022 high. That would carry the market all the way down to S&P 2250 by our calculations. With that, I would like to invite you to visit our website at jwhinvestment.com or follow us on Twitter at alpha_insights if you'd like to get some more information on the work that we're doing. Other than that, I wish you the very, very best this holiday season, and I want to thank you for watching today.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.